This ticker podcast is coming to you from the Citadel Securities Trading Post on the floor of the New York Stock Exchange.
Hi, everyone. As corporate valuations soared ever higher, 2019 was supposed to be a great year for IPOs, but it wasn't. Instead, the shares of many newly listed companies languished. Other firms postponed their listing plans. What went wrong? And what will it take for a company to successfully enter public markets this year? My guest at the Post today dropped by to help answer those questions. Patricia Graue is director at Brunswick Group. She's worked on a slew of initial public offerings, including those of Facebook and Alibaba. Graue says stock market splashes in 2020 will all have three things in common. And we'll find out what those are right now. Let's dive in. Patricia Graue, welcome to the Ticker Podcast.
Thank you, Jeff. It's wonderful to be here. Thank you for having me.
What's wrong with equity markets and why aren't IPOs doing any better?
I think a couple things are at play here. I think the first is, if we just all back up a second, it is enormously hard to go public. You have to, a company's management and their advisors have to learn how to play a different sport as they continue to play another sport. So it's like learning to play basketball and you're playing baseball at the same time. So what does that mean? You have to completely, I think, to go public successfully, you have to, there's a lot of preparation that goes in. You have to refine and tell a story and a narrative that will land well with the public markets. Many times it's a different narrative than what you've been telling to your private investors for years. And third and most important, you have to get to know and convince public equity investors to invest and take a risk on your company. And that is very, very difficult and very, very different. And the other thing that I always think about with IPOs is that you kind of can't go back. Like once you go public, you're public. It's really hard to go put yourself back in the box.
Although they are doing it more and more.
They are doing it, and of course we saw at least one company withdraw from pricing, a couple hours before pricing in September. But there's, once you go public, it's very hard. I mean, to go private again is quite difficult and usually involves quite a bit of debt. So I think, that's one thing that I very much admire companies who are trying to go public because it is such a difficult process, which is why so many of them delay and wait and to do it. And also why today we have more private equity-backed companies in the U.S. than public companies. So I think that's one thing.
I did not know that.
Yes, so it's a McKinsey statistic, but it's something that is extremely important. So I also think though, some of the things that's also happened this year is you had a number of companies that, what would you say, the American reading public, the global investing community has long anticipated to go public. Uber, Lyft, Airbnb, which did not go public this year. These are companies that, for a lot of us, are names that companies we know and use every day. We've read about it in the newspaper for years. There's been reporters at the Wall Street Journal who've had their whole beats dedicated to them for years. So long anticipated, and from an investor perspective, long anticipated as well, because as we all know, investors are a lot of times looking for growth. Tech companies in particular have been growing faster. Overall, if you looked at public tech companies, their rates of revenue growth, annual rates of revenue growth over the last 3, 5, 7 years have been more like 10 to 20%. So, investors are always looking for growth. They were anticipating, and most public companies overall, their top line growth rates are more like 5 to 7%. So, they're looking for growth. So it's long anticipated these companies will come to the market and have a great run. So I think there's a pice of that as well. So anticipation.
I don't want to lose your thought, but can I back up? I thought that was the problem with these companies. They wouldn't have any revenues. There was no growth.
So I think, well, I look on it as, I have a different take on it. The companies that I saw that so many of us were the headline companies had growth rates of, healthy growth rates of at least 10, 20, 30, 50, even 100%. Pinterest, revenues doubling every year. That said, they did not have profitability. And so I think this is the other thing. If you were saying these companies were long anticipated, they almost were like so cool, they couldn't get any cooler to investors. And so they were almost set up to fail in some ways. They've been private for so long. But as I also think there's something that happened with investor expectations for profitability that I think is also extremely important here. You can say that market conditions changed, or I personally think there's the mismatch between like what public equity investors and what private equity investors expect for profitability was not really fully explored in the markets, and that's a substance problem as well as an investor narrative problem. It's not just what you do, but how you talk about it. What is your runway to profitability? I also think there's a bit of market conditions changing where if you looked at surveys by banks and consulting firms of the outlook for the economic cycle, CFO, CEO sentiment, it's long been expecting a growth slowdown. I do think people became nervous again throughout the year, particularly into the summer. And since they were more nervous about market conditions changing and the economic cycle changing and recession coming, they became worried not just about growth, they became very worried about profitability and operating sustainability, and could a management team actually of a newly public company, could that management team actually weather a recession and a change in the management cycle? Because as we all know, we all have been around when a recession happens, as during the financial crisis, you've got to be able to manage your operations and your financials sustainably through a recession. And I do think some of these public equity investors looked at some of these companies with amazing growth but low profitability and no sustained path to profitability, and questioned whether or not these companies could really get through a turn in the economic cycle, a multi-year turn in the economic cycle, and a very strong slowdown in global growth. Did they have the equipment and the capability to get through it? So I think, anticipate huge anticipation for these companies, a change in market conditions, as well as a mismatch in expectations around profitability that I think is very critical and very important.
Don't want to go too far down this rabbit hole also, but a recession comes up. Is that going to, how will that affect the private market? Will it make public markets more attractive in a recession, or the opposite?
I guess it's such an interesting topic. The first thing I think of with private markets is two things. Number one, the credit markets will change so much, as we all credit markets are like the harbinger of recession coming. And if companies, there's a ton of large private companies that are not profitable, and they have to turn to the credit markets at least periodically, or their private investor owners have to turn to the credit markets periodically to finance their debt. If those credit markets close, then yes, one of the possibilities would be for those companies to go to the equity markets, right? But how hard will that be, right? Because again, we have transparent equity markets, so all of investors, analysts, everyone is going to know this company couldn't take out debt, so now they're turning to, the public markets to raise capital, and that'll be super tough on valuations, and that's a super hard story for an investor relations leader to tell and to engage with investors over.
The debt markets snubbed us, and now we're coming to you.
Right. That's just so difficult, and as well, there's of course a bit of there's communication between between credit investors and equity investors, right? So there's some ability they will know what is happening, and there's been this summer we saw some large issuances, some large debt issuances in the leveraged loan markets in particular hit rocky shoals. So like July, August, September, you saw 5 or 6 big debt issuances in the market run into trouble. Not huge trouble, but run into some trouble. Enough trouble to make Bloomberg headlines, to have financial credit reporters actually publish articles in the Journal and Bloomberg, right as that's happening, you have a pause in the IPO markets. Well, everybody waits for WeWork. So I do think that really affected, to go back to your question about what happened, I think that was, people took that as a signal that the market conditions were changing as well.
Getting some breaking news on WeWork.
Archetypal WeWork unicorn
is now
really quite understands the business model.
Pulling its
Huge
IPO.
issues with
They
corporate
said for the record now the
I don't want WeWork.
equity markets in the future.
WeWork was kind of the fulcrum that everything kind of turned on.
I believe WeWork, particularly the content in its S1, was not what someone closely following the company necessarily expected. And so, and of course, the markets do not like to be surprised. And I do think that people took stock of what was happening at that moment. September is always tricky with the markets, as we sit here in this amazing New York Stock Exchange. We know that. September, everybody comes back from summer vacation, takes a look at their portfolio, thinks about what they're going to do at the end of the year. It's always a tricky time. And what was so fascinating about WeWork was that at that time, the markets were up, but active investors were not having a great year. And so two things were going to happen, broadly speaking, and was either they were going to go hard onto risk and go into a WeWork, no matter what the numbers said, or they would completely come off.
Okay.
And I do think some of the financials, the situation with WeWork was a very difficult one. I also think the narrative, how the story was told was just at a time when investors were potentially more skeptical about what was happening. The CEO letter spoke of the company's mission as elevating consciousness. So just as investors are focusing on profitability and hard numbers and thinking about market conditions and slowing global growth, you have a mission and a sort of overall investment engagement approach that there's a mismatch there that was very interesting to.
There's just too much story there? Is that and not enough numbers?
I think the story was a story that didn't match necessarily what their investors wanted to hear at that time or were looking for. And I think also, Jeff, this leads to kind of just that difference of public equity investors in an IPO, right? So, average holding time period for a public investor is 8 months? Like an institutional investor these days, at most it's 8 months. So that's very different than late stage private companies investor base, which is usually investors who are holding the company for years. And if you're a portfolio manager at a public equity company, maybe you've got 80 to 100 stocks in your portfolio. You've got maybe some analysts who help you think about things, and even if you meet with the CEO in many testing the waters meetings, they've got hundreds of companies on their radar screen and that they're thinking about. They also have a set of incentives that's very different. So I do think there was somewhat of a mismatch of how to engage, how to approach those, what story to tell, what narrative to deploy with them, and how to deploy with them that was occurring there. I'm not saying it wasn't occurring with a lot of the different companies that we saw, in the last year or two. This was just the apex in some ways.
Near the session lows for Uber stock. It's down about 9% in trading today.
Do private investors
not an
somehow
auspicious start for
know
Uber.
something more
Now, we were
or
talking to
less
some of the
than the public market?
Investors have
If it has
5
no
years
cash
to wait
flow,
for something
then
to
just
become profitable, because look how great it worked for Jeff Bezos.
Like concretely, why did Uber flop?
So I personally think Uber is an example of a long anticipated IPO. How could that IPO ever have been successful? They had 200,000 private investors. So they basically, in some ways, were already operating like a public company without a public company, without some of the transparency that's needed. It's just so difficult for them to be successful coming onto the market, because if you were with 200,000 investors, if you were looking at that company, it's hard. you struggle to understand how there's going to be any money on the table, money for you, how there's going to be future growth, a future fast, good return for you.
What, they just didn't explain that story?
I think it was a very, very challenging. I think that's somewhat is a communications issue, and definitely there's a piece of that. But the biggest communications issue being convincing investors that they're actually new investors, there'd be a substantive return for them. So, because if you looked at that company, you would see that with 200,000 institutions in the stock already, they've probably already gotten all of the amazing return that could be generated. Was there going to be a return really for them going forward? And then second, on the messaging component, that path to profitability, convincing those already skeptical investors, are already skeptical about the potential return, that indeed there's going to be a return for them possible, that there's going to be profitability, there's going to be cash for them, that the business model actually has, legs long term is an enormous challenge.
So that's the lesson we learned from last year. Segueing again a bit, but as we've been speaking, 10 bazillion shares have just traded hands, and it's all index funds and stuff. What's the effect of that on the IPO market? I mean, I think it's more than, I don't even know what the number is, but it's taking over the market, right?
Totally.
Yeah.
It totally is. It's I think the last numbers I saw were 2018, 2017, index funds or passive investors made up 37% on average, stocks, public share base. And I think it's probably even more and more, as we know. It's such an interesting issue. I think the first is, if you're an active investor, you wonder what's going to happen with passive investors in a market downturn. We've never gone through a market downturn with passive investors having such substantial shareholdings of a company's shareholder base. So this is very different from 10 years ago. And so I do think that causes some anxiety in itself. That's because of their difference. The second thing I think is that they have, as your readers, all of us know and have read what Larry Fink has written, what different leaders at Vanguard have written over the years. Those passive investors are in the stock no matter what, for good or bad, and they care more about ESG issues. And they care about the economic, social, and the governance all the same. And so I do think those come to the fore in ways that are different than perhaps 5, 6, 7 years ago with newly public companies. And they also engage very, very differently with companies coming onto the market. So they have things that they care about, but they're not necessarily as open with a company coming public as perhaps some of the other actively traded, active investors are, actively managed fund managers are.
And the upshot of that is, in our upcoming recession and prevalence of index funds, the outlook for IPOs in 2020. We don't want to do what they did in 2019. What are they going to do different that's going to bring back the market?
Well, so first of all, I still think there's quite a few that I think there will still be a market for well-managed, strongly growing, profitable or close to profitable companies. There will be a market for there will be an IPO market. I do think there's still a great deal of interest from investors in newly public companies. That has not necessarily changed. In terms of, I do think there's a need to think about the narrative for public equity investors and how to reach those investors with that narrative more, maybe in a more targeted and in a way that lands well with them. I think there's less about assuming that broad statements that a company will be profitable, that just reaching investors kind of through some of the traditional ways may not work as well. I do think that a lot of us are going to, of course, watch the global growth outlook. I think we all know that what happens between the U.S. and China will also be very important from a transactions perspective. U.S.-China transactions are investing is difficult right now, so it's one thing. Just as important is the changing sentiment between these two countries. Not just the trade dispute, of course. There's a lot of news on the trade dispute, but I think we've got some survey data that says 60% of American consumers want their American CEOs to take a stand on China. The flip side is something around 2/3 of Chinese consumers say that they have boycotted an American product in China in the last year. Something around 40 to 50% have changed international travel plans not to include America in the last year, or will tell a survey, somebody surveying them. So there's a lot of different ramifications from an investor perspective for
That's
that.
a real
as
brand
well.
issue.
It's a real brand issue, and Hank Paulson just has made some statements warning against the pulling apart of China and the U.S. economically, over the last week or so. So there's a lot to think about between these two countries, their capital markets, the investing community, as well as a company's operations. I think a lot of China is a huge source of growth, as well as of profitability for American companies, and it's a huge driver of global growth, global prosperity, as well as is the United States. So I think there's quite a bit there to think about, and will be very interesting. And the third, of course, piece would be the political season in the United States and how all of that plays out. And and the expectations on CEOs and on companies to navigate that political season as well. So, and of course, that's super challenging for an IPO, for a company trying to go public. You're already media catnip as you try to emerge onto the public markets, and then you have the overlay of political season, as well as China politics, as well as global growth to think about. So it'll be really fascinating to see what happens. But I do think there's quite a bit of preparation in terms of messaging and communications, and in smart investor narrative to think about in terms of growth and profitability at this time.
It's a communications minefield. It's a new dawn in communications.
I think
there's something happening, and a lot of
people.
people don't know what it is, kind of thing, right
Yes.
now. And that's why these things are flopping.
Yes, I think that, and I also think that one of the things I've learned a ton about since I was an analyst, and of the evolution of the last couple of years, is how people find information and the expectations of where they're going to find information. So, as an analyst, I used to laugh that I was like a professional Googler. I spent so much time Googling things, searching for things, turning up things on Google. That is absolutely still important. That is still the number one way that investors and analysts find their information and make decisions. Full stop. But it's also true that there's a growing expectation among investors and analysts that a CEO engages on social media. We have survey data that shows that half of investors and analysts expect a CEO to be on digital media. That's investors and analysts. That's not the American public. So they expect a CEO of a public company to be out on LinkedIn, on some kind of social media channel, speaking to them or speaking to the broader public of some kind. So I think what's also changed, we talked about the mismatch of a narrative. What's also changed is how investors are finding information, what information sources they trust. Of course, Google's always first, but then, the Journal and the Financial Times are also very trusted. Some of the top newspapers are very trusted. So is Wikipedia more and more. And huge numbers of investors under 30, which to me means a hedge fund analyst, are looking at social media channels in depth for information on stocks and making decisions on stocks based on that as well, which has very much surprised me. So I do think that change as well is something for companies to think about. And if you're going public, there's all these rules about going public, right? Lots and lots of regulations about how you talk to investors and when you talk to them. The more advanced work you can do around your website and your social media channels months ahead of going public, the better. And there's more and more sophisticated ways to target investors, to target potential investors, target your analysts on social media, so that when you do go public, they have already a baseline understanding of your company's business model and proposition. So that's also part of the new dawn, I think. It's not just the message and the marketing conditions, but the information sources that people are expecting.
I've been writing about this for 10 years, social media, and still I came across a statistic, something like, 50% of companies, big companies, aren't on social media. Or if they are, it's like, LinkedIn or just one kind of channel or something.
Yes, and it's actually an expectation. So our digital investor survey results show that half of our respondents, that would be investors and analysts, expect CEOs to be on social media. It is not, they're happy for a company to maybe have a Twitter account. There's an expectation. And that is the earlier that a company thinks about that, late stage private company, the better, because going public is just so much work. You have a 400-page document to produce. You have new investors to go out and meet. You've got presentation materials for them as well. There's a ton of media attention almost always on public companies. There's a ton to do. So the more you can do some of the advanced work on not just the narrative, but on the channels that you'll reach investors, the better. And in partnership with communications, investor relations, and the company's leadership, the better.
Patricia, what's the downside of a direct listing?
So I think they're completely fascinating, and there's tons of upside in terms of a company's ability to actually, very strongly control its emergence onto public stock markets. The downside is that the burden is so much more on the company to recruit its investors, to tell the right story to investors, to engage those investors, and that can be very, very hard. So it means instead of having, a bank put together a roadshow schedule of all of your investor meetings, you yourself many times are sort of leading the way to figure out how to find, target, and educate those investors and convince them to invest in the company. And that's quite a lift. And the second, of course, is that it's a lot of times we're not raising capital or no capital.
Yeah.
At that point, at least with the...
Or you never are, right?
With the offering. With an IPO, you can raise capital.
A direct listing, though.
Yeah, direct listing, you never are.
Right.
So maybe you can, with the secondary, another offering, 6 months down the road, but not with that. So it's quite a bit.
So run that by me again. The downside is...
The biggest downside I see is you have to target and educate investors largely much more yourself. You're a bank, an underwriter, your underwriters are not nearly as involved in thinking through how to target and find your investors.
Might be a good thing, right?
It could be a good thing, but the best bankers are wonderful storytellers and have a really strong understanding of what investors are looking for from a public company, what message they need, what data and facts they need, as well as how to give that information, provide that information to investors in what form, in what sense, in what place, time that makes sense for them. So there's much more of a burden with a direct listing on the company itself for that.
But they go out and they get a consultant, and they basically perform the functions of a investment bank without the biases.
Potentially, but I think there is such strong expertise in banks for this type of thing that is for targeting and educating investors, and the best bankers are incredible storytellers. They're incredible financial storytellers. It also means that, basically a company, while still, for a direct listing, and Spotify did this to great success, they have to almost on their own put on an investor day for the first time as a private company. So the meetings and things that need to happen, you've got to find some way to educate investors. A lot of times one of the most efficient ways to do that is the equivalent of an investor day or a great big huge investor meeting. They have to do that almost by themselves. Come up with the material, rehearse, figure out what they're going to say, where they're going to say it, and make sure that it's as authentic to the company as possible.
This would be even before the listing.
Yeah, because you've got to find investors who will buy your stock when it starts trading on a direct listing. So it's much more, because of the process, it's much more on the company to do that than, the underwriters are not as involved because they're not underwriting. They're just advising as banks. So it's a direct listing. So it's a much bigger burden. So
Is it cheaper?
it's cheaper.
Yeah,
Oh yes,
it is
it's absolutely
cheaper.
cheaper.
Yeah,
It's
okay.
absolutely cheaper. It's absolutely cheaper. There's more work to do on the company itself, on this investor engagement piece, and that is it's a very complicated task, and it's critical. So
It's kind of your task, though, isn't it?
it can be.
That's what you do.
So we do that, and we also work in partnership a lot of times with bankers and lawyers on
Okay.
IPOs as well. So, but we have worked on direct listings, and they are great fun because they are the opportunity for a company. A direct listing allows a company to really reveal itself and its way of doing things. So this is very much the case with Spotify and Slack. You got really a sense from the direct listing of who they were and how they were going to engage. Who stood in the room and who presented for the investor meetings. So, and those were of course public. Anybody could go to them. So very different than a roadshow. So much of an IPO for a direct listing is an introduction to public stock market and to public equity investors. And so figuring out how to speak their language, how to play their game, how to meet them where they are becomes extremely important. And the more understanding there is that game is different than the private capital game, the better.
And that's a wrap. My thanks to Patricia Graue. You can find Brunswick's latest white paper on crafting a compelling investor thesis at irmagazine.com. And while you're there, I note you'll also find a fairly robust library of white papers on IPO communications in general. I'm Jeff Cossette, and thanks for listening.
Citadel Securities is a member of FINRA and SIPC. The content of this podcast does not necessarily reflect the views of Citadel Securities.